commercial banks are just the lackeys of the central banks, making tons of money with sovereign immunity. And this is a game, just like all manipulations, ultimately, that end poorly. And you're beginning to see that happen right here, right now in front of us, with all of the deliveries coming off the LBMA and COMEX. When that happens and there's no metal left to use to suppress the price, and people say, well, we're going to stand for delivery, Houston, we have a problem, a big problem, because you do not, this is a short squeeze. You don't have the metal available to deliver. Like LBMA says, yeah, it's an 8-week delay because we don't have enough in the way of trucks and manpower. So the Bank of England doesn't have enough in the way of trucks and manpower to move the metal that I own. I'm expecting in less than a week, and you're saying 8 weeks? That's a problem.
Hello everyone and welcome to another edition of Triangle Investor Interviews. I'm your host Lucian Valkovic, and before I announce my guest, just a reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy or sell any shares, products or services. Always do your due diligence and consult with your financial advisor. My guest today is Andy Schectman, CEO of Miles Franklin, a well-known and respected name when it comes to the precious metals and markets. Andy, delighted to have you back. Welcome back, my friend.
Good to be back, brother. Thank you for having me. Hope you're doing well.
Yeah, thank you very much. Andy, in today's edition, I would like to cover more the manipulation in gold and silver markets while still covering fundamentals and price dynamics. Of course, you've often referenced manipulation in gold and silver markets, particularly through futures and paper contracts. My first question to you is, what specific evidence of patterns have you observed in this year that confirm ongoing suppression of spot prices, and who are the primary actors benefiting from this?
Well, I mean, it's the commercial banks. There's about 8 Western banks that hold the largest concentrated short position in the history of the COMEX market on any commodity traded in things like silver. Silver is the primary one where you're seeing tremendous suppression. You also see it in platinum. These same 8 traders, their footprint is everywhere. And they suppress the price into COMEX. And you look at, for example, the AM fix and the PM fix in London, where the price gets smashed every single time that we see the fix, either AM or PM or heading into New York. This is something that, I mean, we could spend an entire episode talking about the suppression, but I think that the real issue, if I had to guess, was that it's not really at the desire of these commercial traders to suppress the market. Commercial traders are happy making the profits. If I had to guess, I would say it is at the behest of the central banks who are telling the commercial banks by proxy to do just this. When you see naked shorting, for example, let's look at London as an example. London right now, the LBMA, the 140-year-old exchange, the oldest in the world, we'll focus on silver for a moment, has 155 million ounces of silver in the vaults. It's the lowest amount of silver they've ever had in the vault since they started keeping records. They call that the float. Now, the actual number of ounces in the vault is closer to 800 million. But that 645 million ounce difference belongs to the ETFs primarily, like Bullion Vault and SLV. So this is silver that is already encumbered. The 155 million ounce float are the ounces that are backing the contracts in circulation. Now, they admit to trading somewhere in the neighborhood of 190 million ounces per day. So they're already trading more than the float every single day. But if you look at and speak with a man named David Jensen, who I would strongly suggest you have on your show, his reporting is fantastic. And he says that the banks, the bullion banks, they took a survey a few years ago, and they admitted to the fact that the numbers that we see are roughly 10 times understated, because they only post the final settlement numbers on the exchange. They don't post the number of trades that were used to get to the final settlement. And so they're trading upwards ends, by his estimation, of 1.9 billion ounces per day. every day off of a 155 million ounce float. Now, what could possibly go wrong with that? And this is why, for a good portion of the year, the LBMA is what's called a T+1 exchange. T is the trade day plus 1 to settle. By the third day, the metal should be moving out of that account into yours or being shipped. They told the world, sorry, there's a shortage of manpower and trucks at the Bank of England, and so we're T+8 weeks right now. So in essence, it's as if they got caught with their pants down because we're seeing so much in the way of deliveries leaving London. By the same token, the gentleman who runs the Tokyo Metals Exchange, he used to be the head trader for ICBC for Japan, and in trading metals on their metals desk, and now he's running the market at the Japanese precious metals market, and he's the head guy there. And he says, just the other day, I forgot his name. If I went through my notes here, I could find it. But he says, there is no platinum, virtually none, local, meaning location, London and Zurich, yet the LBMA is trading as much as 3 million ounces per day of spot contracts, which are deliverable with nothing behind it. And this is the kind of manipulation that we've seen over and over and over and over again. Now, in terms of gold, I would argue that it has been used, and it seems to be breaking with gold, but it has been used to suppress the illusion, or to support the illusion, rather, of a strong bond market, of a strong Western system. And if you create an environment for many, many, many years where you suppress interest rates to create an illusion of reality, an illusion of wealth and of stability in the Western system, you have to step on gold and silver, which are the canaries in the gold mine, in the respect that there's a term in economics called Gibson's paradox, which speaks to the inverse relationship between real interest rates and gold. And so they've stepped on gold forever to support this illusion of a strength of a Western system, of a bond market, and of a currency system. This is a game that has been going on for a very, very long time, and who it really benefited were the central banks, so that no one would question the value of the dollars or the pounds or the euros that were being used all around the world. No one would question the stability and authenticity of a bond market that was being used to act as the skeletal system, if you will, around the globe of liquidity and of stability and of authenticity. All of this stuff, if you're going to suppress interest rates, which is really what this all boils down to create this illusion of wealth, as we've offshored all of our manufacturing across the globe, you have to step on gold. And this has been going on for a very, very long time. Now, what's happening is that you're beginning to see countries in the global south, like the BRICS, who have become sophisticated, motivated, coordinated, and wealthy, and they are exploiting the backdoor option that is found in all of these contracts, and that is to stand for delivery, which no one ever did. Majority of my career, nobody stood for delivery. Less than 1% stood for delivery. And so when you realize that, when you see no one standing for delivery all of these years, and now all of a sudden we're seeing massive deliveries off the LBMA and off of the COMEX to the point where, it's unlike anything I've seen in 36 years. It has become very obvious that the rest of the world understands this. Speaking of the BRICS, they've developed what's called the BRICS Grain Exchange, and it's just what it sounds like. It's a grain exchange for the folks in the BRICS nations. And the gentleman who's behind it said, we produce more grain and consume more grain than the folks in the West do, but yet we don't have any ability to control the price. That's controlled on COMEX. But with the development of this new system, this new BRICS Grain Exchange, that will change. In other words, they understand that this is happening with all commodities, not just precious metals, but this is also happening now in the United States. I'll give you an example. I have numbers here from the first 3 days of the August gold contract, which is all but over right now, and the numbers are far higher than what I'm going to tell you right now, but this will give you an understanding. On COMEX, for the first 3 days of the August gold contract, right, August 1st, 5th, and 6th, 20,126 contracts were posted. That means they're posting for settlement. Most of my career, I would tell you that less than 1% of contracts stood for delivery. They would either be cash settled or rolled over to the next month. Of the 20,126 gold contracts, which represent 100 ounces per contract, or 2,126,000 ounces of silver, of gold rather, roughly $7 billion worth, 100% of those 20,126 contracts stood for delivery. They weren't cash settled, they weren't rolled over. 100% of them did. That's $7 billion worth of gold that stood for delivery in the first 3 days of the August contract. This is the same thing that we've been seeing over and over and over again. Someone got into Trump's ear, if I had to guess, and told him that this was happening. And if we don't start standing for delivery, we're going to end up losing to the rest of the world who understands what's been going on, that the West has been suppressing the world's commodities for various reasons. With gold, it was, as I mentioned, to support the illusion of the strength of the bond market in the Western system. With silver, I would argue it's different. With silver, I would argue it's the military-industrial complex who needs copious amounts of silver to make high-tech weaponry. I have validated from a client of mine who 3 years ago at a conference in Vancouver said to me, "You're right," when I said that there's 500 ounces of silver in the tip of a typical cruise missile, a Tomahawk, a Patriot, Hellfire. They all have silver in the guidance system, between 13 and 14 kilograms. And it's not so much the price that worries the military-industrial complex as much as it is the rest of the world understanding that silver is not industrial. It is, in fact, strategic. In fact, I just saw this morning that the U.S. government did something that I am very surprised by, something that is long overdue. And I could have sworn I saved it. Where did I put that? Have it. They reclassified it as, I want to call it strategic, but hang on a second. If I don't have it, I don't have it. I know I saw it this morning. Don't think I have it. I'll have to look for it. But the bottom line is, silver is, as far as I'm concerned, strategic. Now let's look at the silver numbers over the first 5 days of the August contract. Remember, no one ever stood for delivery with silver. But to my point about the military-industrial complex, that's BlackRock. Let's say they own all of the manufacturers that produce these high-tech weapons, right? the military manufacturers of high-tech weaponry. They're also the primary custodian, along with J.P. Morgan, of SLV and GLD. SLV is the largest silver trust in the world. And so you think about it, they suppress silver to build high-tech weapons, so that, you know, if the price were to go higher, it would signal to the world that, hey, silver is more important than we are being led to believe, and maybe we should accumulate it. And so they hold down the price to keep it and make it very counterintuitive, to keep it off the radar. Now, BlackRock builds the weapons. In essence, they own the companies that build the weapons. They need silver. Then they are sold all around the world to fund war. Places like the Ukraine and Syria get blown up, and then who gets the reconstruction contracts? That's right, it's BlackRock. And so this is a very insidious game, if you will, of holding down the world's commodities for various reasons. But over the first 5 days of the August contract, in fact, it was closed August 1st and 4th, so just the first really, well, actually it wasn't. I take that back. It was the 1st, the 4th, the 5th, the 6th, and the 7th. Those first 5 days, COMEX market received, what did they receive? They received a total of 1,002,000 ounces of silver. That's a lot to be received into COMEX in the first 5 days. 1,721,192 ounces over those first 5 days withdrawn out of COMEX, leaving the vaults. 1,890,316 ounces. So in other words, you're seeing the price being held down for various reasons. Silver, the military-industrial complex; gold, to support the illusion of the bond market and the strength of the Western system, the currencies. And now they're being exploited by not only players around the globe who are coordinated, motivated, sophisticated, and wealthy, but also players here in the United States. And we don't know who they are. So between the 1.89 million ounces that were delivered in the first 5 days and the $7 billion worth of gold, over 2 million ounces of gold in the first 3 days, you're talking $15 billion worth of gold and silver that left COMEX within the first week of the August contract. Now, we're almost to the end of the month, and those numbers are much higher. But my point to you is that this is far deeper than arbitrage, than in profiting. There are players that are pulling the strings that have been suppressing the price of gold and silver for a long time to maintain Western dominance. And these other countries have exposed it. They understand it. They know what we're doing, and they're beating us at our own game by suppressing the paper price in places like COMEX. They're doing it themselves, and then standing for delivery all around the world on exchanges that do not have a bearing on the price like it does here in the United States. It sets the price, or in London. They'll take it off of every exchange across the globe where prices aren't affected. The Chinese, which are the second largest producers of silver in the world and the largest producer of gold in the world, as an example, are going all around Latin America, in particular Peru and Mexico, and pulling silver out of the ground before it's even called silver. They're buying concentrate and doré directly from the miners. Concentrate's a sludge byproduct of the mining process. Doré is a crudely refined bar that the miners will fashion and then send it in for full purification. And they're buying it directly from the miners, paying double what the West will, and shipping it back to China for refining. So this is a battle for the world's commodities. And the folks at the highest level understand that by suppressing the paper price, you can misdirect the public. You can misdirect the investing public. And then quietly now, for the past couple of years, we've seen this massive rush for delivery, which is 4 feet of snow in Death Valley in July. It doesn't happen, but it is happening. The United States has become a net importer of gold since November. I believe that someone got into the administration's ear, into Trump's ear, and said this needs to be done. And so the number of ounces of gold and silver and platinum that are standing for delivery in the United States is so far an anomaly. Over the last 36 years, I've never seen anything within a country mile of what we're seeing right now. So it benefits the central banks by allowing the system that they construct and run to be supported, even though it's illusionary. The commercial banks are just the lackeys, if you will, who are being, in essence, being given cover, if you will, by the central banks to by proxy to suppress the price, and they make the profit in it. All of these contracts expire worthless. It used to be they would suppress the paper price, take the proceeds when no one was buying it, and put it into treasuries, which would suppress interest rates. They would make the spread between the return on the treasuries and the 0.5% lease rate that the central banks would lease their gold to. So they were suppressing the price, leasing gold from the central banks at 0.5%, selling it to the market, driving down the price, taking the proceeds and buying treasuries, driving down interest rates. So now the central banks are happy as hell. Interest rates are low, metals are low, Gibson's paradox. You can't have low interest rates with high gold, and you should, because Gibson's paradox says if you have low interest rates, there's no opportunity cost. Gold should be high. Step on that, right? And so they stepped on it, and they would make the spread. They're happy. They're being given, in essence, sovereign immunity by up above to do this. Now, this all came out in a lawsuit that Blanchard, the gold company in New Orleans, levied against American Barrick and J.P. Morgan in federal court about 15, 20 years ago, where this was admitted. The case was sealed, but what we took away from the findings was that American Barrick agreed to close their gold book, admitted to holding down the price or forward selling their production into the market at the behest of J.P. Morgan, but they claimed sovereign immunity because J.P. Morgan, by extension of doing it on behalf of the U.S. Federal Reserve or the U.S. Treasury, they claim sovereign immunity. That's pretty much, if you Google it, you'll read this and you'll understand what I'm talking about, but this has been done specifically for the Western central banks who are now being caught. The commercial banks are just the lackeys of the central banks, making tons of money with sovereign immunity. And this is a game, just like all manipulations, ultimately, that end poorly. And you're beginning to see that happen right here, right now in front of us, with all of the deliveries coming off the LBMA and COMEX. When that happens and there's no metal left to use to suppress the price, and people say, well, we're going to stand for delivery, Houston, we have a problem, a big problem, because you do not, this is a short squeeze. You don't have the metal available to deliver. Like LBMA says, yeah, it's an 8-week delay because we don't have enough in the way of trucks and manpower. So the Bank of England doesn't have enough in the way of trucks and manpower to move the metal that I own. I'm expecting in less than a week, and you're saying 8 weeks? That's a problem. This is the beginning of the cracks starting to show.
Yeah, that's a great analysis. Andy, I would like to hear your take more on the manipulation endgame. If manipulation in gold and silver markets were unraveled, let's say in 2025 or 2026, never mind, what catalysts like regulatory changes, market crashes, supply shortages could trigger a free market price surge? And what price levels might we see after that?
I think all of those things could very well trigger this event, as well as an overt revaluation of gold, devaluation of the dollar, which I do expect. Truthfully, I do expect that they will do this. Gold is held on the balance sheet of all the Western countries in an account, you can't make it up, called the gold revaluation account. And I think that it's becoming, through delivery, through all these entities standing for delivery, it's becoming inevitable. And I just think that it would benefit all the central banks to revalue the price of gold. My thesis is that they will do just that, to devalue the dollar. Ultimately, they want this to happen. They realize that they have really no choice but to either inflate or default. I think they've chosen the third choice, which is to soft default on the dollar, to give up the world reserve status. We don't want to be. There's something called Triffin's dilemma, which speaks to the fact that if you are the world reserve currency, you will always forever run a trade imbalance, that we cannot give the world enough dollars alone just simply through trade. So those countries that need dollars will have to sell their currency to buy ours, making theirs weak and ours strong. And the continual pattern of the selling of other currencies and the buying of the dollar makes the dollar strong. The manufacturing in the United States gets hollowed out because we can make things much cheaper around the globe, way cheaper in cheaper currencies. This is the crux and the problem of Triffin's dilemma. You had Vice President Vance come out and specifically say that, even on White House letterhead, citing Triffin's dilemma, that, hey, maybe being the reserve currency at this point isn't such a good deal for the United States. You saw Stephen Mirren just take the open spot that was just vacated at the Fed. He is the author of the Mar-a-Lago Accord. He wants a weak dollar in order to bring back manufacturing. So if you realize that all of the things that we are doing by running constant budget deficits, so over $2 trillion this year, for sure, and raising the debt ceiling by $5 trillion and being massively indebted, that holding dollars is a very silly thing right now. I mean, the dollar's down 11%. The rest of the world, I think, is beginning to understand that putting your money in dollars and treasuries maybe not the best thing. And this, to me, is kind of by design. So if you look at what they would actually do, they would massively devalue the dollar by revaluing gold. So let's look at some of the clues that would support that. Number one, you have President Trump. We've become net importers of gold since November for the first time ever. Well north of $100 billion of gold has come in that we know of. And a lot of it's probably coming in not through COMEX, into private vaults that are owned by the JP Morgan and the Citibank and all of these channels that aren't documented. And I believe it's probably, if I had to guess, the Treasury Secretary bringing most of this gold home under the guise of the Exchange Stabilization Fund, where he wouldn't need to report it to Congress if it was under the pretense of national security. It's all coming in here. Now, President Trump on Easter Sunday says, he who has the gold makes the rules. Now, what the hell does that mean? The Treasury Secretary, Bessent, is a self-proclaimed gold bug, says he wants to preside over a new Bretton Woods, a new monetary system. He says that he wants to revalue part of the revalue the assets of the U.S. balance sheet. If you look at the United States government balance sheet, it's $5 trillion. The largest asset is student debt of about 40%. The next largest asset is military, bases, airplanes, bullets, guns. You're not going to remonetize any of those things. But gold you could. It's held in the gold revaluation account. How about Judy Shelton, who was Trump's nominee to run the Federal Reserve in 2016, and many think will be on the short list to run it this time when Powell resigns. She came on my podcast and she told me, Andy, in no uncertain words, Trump told me on July 4th, 2026, It's a very big day for him. It's the 250th anniversary of the country. He's going all out to show the world how important that is, and he will peg gold to the Treasury market, to the 50-year Treasury. I said, Judy, we don't have a 50-year Treasury. That's right. We're going to start with a 50, a 30, a 20, and a 10, and they'll be backed by gold. Now, hold the thought. Now look at the stablecoin passage, the Genius Act. That is going to provide synthetic demand for the Treasury market because people around the world, ever since we weaponized it against the Russians, they don't want to hold our treasuries anymore. Not only is the dollar being inflated and losing value, but the Treasury market can be frozen and sanctioned and confiscated if you fall on the wrong side of the West. And we saw that with Russia. Countries don't like that. And so they're looking for alternatives. And they're selling treasuries and buying things like gold, which has doubled the performance of the 10-year Treasury over the last 25 years. Look at last year. 10-year Treasury was up 4.5%. Gold was up 40. Look at this year. Through the first half of the year, a 4.5% Treasury is up 2.25%, but the dollar's down 11%. And gold is up 50% or 40%. It's a 50% swing. How do you find demand for a Treasury market when the world is looking elsewhere? Because we have no way out of this but to monetize and or to inflate and or to devalue the dollar. So you create this stablecoin bill where all of the stablecoins that will be issued by all of the banks under the pretense of speed and ease of transaction, getting rid of checks, and it's like Venmo, bang, it transfers just like that, will all be backed by new issuances of U.S. Treasuries. And Besant says, yeah, probably about $2 trillion a year we'll get. That's going to run the front end of the market up to 2 years and shorter. That will provide the liquidity to run the machine, the U.S. government. The back end, if I had to guess, and we listen to what Judy says, will be pegged zero coupon, maybe a very small coupon on the 50-year. But the shorter duration, 10, 20, and 30, will have zero coupon, meaning zero interest on it, but redeemability in gold. And so the more stupid we are with monetary and fiscal policy, the higher the price of gold will go. So why would we do that? Now, first, remember, gold is held in the gold revaluation account. Roosevelt did it in 33. He confiscated gold at 20 bucks an ounce, paid everyone $20.67. That was a lot of money, with eggs being a nickel for a dozen back then. 67 cents was a lot. And then he immediately devalued the dollar by 40%, making gold $35 an ounce. Nixon did it in 72 and 73. He closed the gold window in 71. In 72, he devalued the dollar by like 8 or 9%, and gold went from 35 to 38. The next year he did it again, from 38 to 42.22, where it's sat on the books ever since. Now, I said to Judy, do you think they'll revalue gold held in the gold revaluation account? And she more or less said yes. James Rickards, one of the smartest men I've ever met personally, who has been brought into the CIA to help simulate financial war games, is saying $24,000 an ounce is what they'll revalue it to. Mike Maloney says $10,000. So, first of all, that would benefit who? All of the central banks who have been buying it hand over fist for the past 5 years, nonstop. But it would also it would help the United States. So how does it happen? Well, the president tells the Treasury Secretary, make gold $24,000 an ounce. Boom, done. The Treasury Secretary tells the Fed, do it. It's done. What happens? Treasury issues the Federal Reserve gold certificates. The Federal Reserve takes those gold certificates and prints the money and gives it directly to the Treasury. Now, that is a gimmick, right? It is a accounting gimmick. Every $4,000 increase in the price of gold would give the Treasury general account $1 trillion free and clear. So they make it 24,000, and he comes up with this number by dividing, I think, M2 into the amount of gold the U.S. has, supposedly, which hasn't been audited. And that $24,000 an ounce would give the Treasury $6 trillion free and clear. So the Treasury issues the certificates to the Fed, who holds the gold. The Fed does not have claim on that gold, only the dollar value of it. The gold belongs to the Treasury. The Fed prints the money, which in essence devalues the dollar by about 60%, and gives the money to the Fed, who now has $6 trillion to work off its debt. The 60% reduction in the value of the dollar makes it very, very easy, you would think, to sell our products across the globe, right? The 0% interest on the long end of the bond market allows you to bring back your manufacturing at zero borrowing costs. Yes, they're redeemable in gold, but zero borrowing costs and a massively deflated dollar would enable you for a period of time to bring back your manufacturing and start selling it, retooling, and selling it across the globe at a very, very, very competitive price. In essence, what I believe they are doing is using the stablecoin passage of the Genius Act to fund the daily workings of the government, then pegging gold to the back end of the curve to have zero borrowing costs and a massively devalued dollar so that you can, in essence, bring back all of your critical manufacturing and put Americans to work building our manufacturing again. And the president will come up and say, if I had to guess, look, this is going to be very painful for a lot of the people in this country. We're going to issue for the next 2 years universal basic income. We're going to give people money because the dollar just got wickedly devalued and massive inflation. And so things like food and energy and housing will become very prohibitively expensive, perhaps. So they issue universal basic income. But he looks the world in the face and says, look, you know, we have 60% of this country doesn't have a college degree. We must be able to manufacture things again. We must be the engine of ingenuity and of manufacturing like we once were. But Triffin's dilemma and the world reserve currency won't allow us to do this. So we don't want to be the world reserve currency anymore. Vice President Vance more or less wrote this on White House letterhead. Google it, you'll find it. And said to the world, look, it's not a privilege to the U.S. anymore to be the world reserve. You're seeing all of these countries trade with one another in local currencies and then settle in balances in gold. You're seeing this all throughout the BRICS countries right now. What he is, in essence, trying to do, in my opinion, is make a soft default on the dollar and shed the world reserve status so that we can bring back manufacturing with zero borrowing costs on the back end, a massively devalued dollar, retool, start manufacturing, put the country to work, and grow our way out of this problem. Because as it is right now, we don't produce anything. We will not grow our way out of this problem. We will either hyperinflate or default. So what is the lesser of two evils? Default on the dollar to support the strength of the bond market. Remember, it's redeemable in gold. In the front end, there is no one buying it. It's a synthetic demand, not an organic demand where people want it. No, the synthetic demand will be anything that is being done. And you'll see not just the banks issue stablecoins, American Express, all the big corporations around the world will issue dollar-based stablecoins, which will support the treasury market, which will give the government money to operate. You bring back manufacturing, you build your manufacturing base, and you grow your way out of the problem, hopefully getting rid of universal basic income at some point and putting the people to work. Because if we don't, everything we need in this country that's really important, like pharmaceuticals, like microchips, like aircraft parts, military parts, everything is being manufactured across the globe, and we can't have that. So how do you bring back manufacturing without, in an environment where rates have to spike? How do you pay off your debt? In 3 years, the U.S. government owes $28 trillion in treasuries that are coming due. But we only take in $5 trillion a year in taxes. You're halfway there. But that doesn't take into account the $2 to $3 trillion a year in deficit spending. So call it 3. That's another $9 trillion. On top of 28, that's $37 trillion we owe in 3 years with $15 trillion in tax revenue. What do? Well, you devalue the crap out of the dollar, you inflate the crap out of the dollar so that you can work down your debt. You give the Treasury general account $6 trillion free and clear to pay off some of these problems, and you start to have the ability to maybe, just maybe, bring back all your manufacturing and start to grow your way out of a problem. In other words, Trump could get up on stage and say, look, this sucks, but we screwed up a really good problem. A trillion seconds ago was 31,688 years ago, and we're almost 200 trillion in debt with Medicare, Medicaid, Social Security, and government military pensions being off balance sheet. If we don't bring back our manufacturing, our children and our grandchildren are in big, big, big trouble. And so we need to do this for our future generations. We need to be the engine of manufacturing again, and the only way to do that is to shed the reserve status. But we will continue to honor and support the bond market, make it redeemable in gold. And then if you brought all this back, you have the ability to grow your way out of the problem. But being the world reserve currency at this late stage of the game, when we are so massively indebted and created an environment for 30 years of suppressed interest rates, where asset prices became Ridiculous. What is real price discovery when interest rates are suppressed forever? What is your house worth at 3%, at 6%, at 9%, at 12%, at 20%? In other words, the suppression of interest rates created illusions and illusions in asset prices and misallocations of resources and of capital. And that suppression of interest rates, which created all these high prices in equities and in real estate and in the bond market, if rates rise too high, and they should when we're inflating, if we're inflating and devaluing, who wants to take our treasuries at 4% for 10 or 30 years? Nobody. You're out of your damn mind. The dollar's down 11% this year alone. Rates have to go up to compensate for that inflation, right? And for that money creation. Well, if that happens, if rates get above 5 on the 10-year Treasury, Silicon Valley Bank and Signature go poof. How about the stock market? How about all of the banks that are holding treasuries? How about the insurance companies that are holding treasuries? Stocks, bonds, real estate, the banks, the insurance companies all vaporize. They can't let rates rise. If they do, the whole system implodes. So, and you can never bring back manufacturing at high rates. So you put zero rates on the treasuries, redeemable in gold, you devalue the shit out of the dollar, revalue gold, which benefits not just the US, but every central bank on the planet, which gives you the ability to back your treasuries with gold, redeemability, which gives you the ability to pay off your debt, bring back your manufacturing, say to the world, we'll be back. Give us a couple years and we will once again be the engine of growth, manufacturing, ingenuity, and stability. We messed up. We're gonna dig our way out of this, and we're gonna do so by growing organically. And there is no other way out in my mind. So this is kind of where I think we're at. And my mentor, Richard Russell, 20 years ago said to me, Andy, the Federal Reserve is so far indebted. At this point, it was only like 15 or 17 trillion in debt, not the 37 or 38 that we have. We're creating about, I don't know, 200 billion a day in debt. 200 billion, I think that's, or is it 20 billion? Let me look and see here. Could be wrong. I think it's probably 20 billion a day in debt. In the past, well, let me just give you the exact numbers. Point of it is that if we don't change, if we don't make a change, we're dead in the water. And this would be for the future of the country and our children. Right now, we are, probably can't find it. I wish I had it in front of me. Here we
Never
go.
mind,
Over
I
the
see your
past
point.
48 days, over the last 48 days, the U.S. federal debt has surged by 1 trillion or 21 billion per day. This can't continue. And nor would anyone want to hold our dollars or our treasuries in this type of an environment where it's being inflated right out from underneath them.
Yeah, I hear you and totally agree with you. Andy, you mentioned confiscation in the historic context. However, do you see any new form, any form of confiscation or new taxation on gold and silver going forward by
The
by
only
the
place
governments throughout the world?
The only place I could see gold being confiscated in the United States would be through GLD and SLV, which are both held in custody by JP Morgan and BlackRock. And you have the largest silver trust in the world and the fourth or fifth or sixth largest stockpile of gold in the world, and they could take those two funds, pay everyone their fair share of dollars, whatever it was worth at the day of, like on a Friday, Monday, it's in your money market account, and they look the world in the face and say, what? We didn't do anything. We just confiscated closed these two trusts that you can't take possession of anyway. You have to have millions and millions and millions and millions of dollars worth of those two trusts in order to take delivery. Like, for example, Saudi Arabia just bought a whole bunch of silver the other day in SLV, enough to where they could demand delivery. But if they close those two accounts, take all the gold and silver held by BlackRock and JP Morgan, they could say, we didn't break any laws or infringe any civil liberties. You can still own physical metal in this country. If we were to activate eminent domain and take gold from the people like Roosevelt did in 33, no one would ever trust us again if we're taking it from our own people. We have bigger problems at that point. In 33, when Roosevelt confiscated gold, it was money. Everyone owned it. Everyone had it in their pocket. No one does right now. People in this country that own gold and silver represent less than 1/2% of the entire financial matrix. I used to joke, because Rick Rule, my friend, used to say, that from Joe and Jane's six-pack to the Harvard Endowment Fund, amount of gold owned by the American public is 1/2%. Well, just the other day, the Harvard Endowment Fund bought $101.5 million in GLD. And Saudi Arabia bought, it says they take a major stake in SLV enough to demand physical delivery. So you're beginning to see large institutions start to understand what is happening, and this is going to accelerate. So I don't think they will confiscate, but I could see them closing and taking the metal within GLD and SLV, which gives them the ability to have their cake and eat it too without taking it from the American public.
Yeah, and the final question, physical gold and silver premiums remain elevated despite spot price volatility. Is this the direct consequence of the manipulation in paper markets, and how can investors actually use premium trends in their favor?
I see the lowest premiums I've seen in my career right now. To the contrary, on the retail side of things, the premiums are muted to say the least. Now, I don't know where you are. Here in the U.S., premiums are incredibly low. And I'll just give you the largest contrarian indicator I've ever seen in my career to explain it. Right now, since the beginning of the year, you've been seeing the institutional traders in the stock market sell between $2 and $4 billion per week since the beginning of the year, every week. You see Jeff Bezos, since June 1st, has sold over $6 billion in Amazon. The three largest shareholders and board members of NVIDIA each sold hundreds of millions of dollars worth of their stock. Jamie Dimon selling. Warren Buffett sitting on almost $500 billion in cash. The insiders are leaving the equity market in droves. 7-to-1 insider selling to buying, 7-to-1. At the same time, the American public has the largest allocation to stock exposure ever, even greater than the dot-com bubble, ever, at about 54% of all stocks are owned by mom and pop retail. At the same time, mom and pop retail have the largest exposure ever to margin, meaning it's levered. They're on margin, over $1 trillion, the largest ever. At the same time, the largest exposure to options, which is speculation. So you have the largest exposure to equities on margin and speculating by the public as the insiders are going this way. On the other side, we're seeing billions and billions and billions of dollars worth of gold and silver stand for delivery on COMEX, which has never happened before. No one stood for delivery, less than 1%. Remember I said the first 3 days, 100% of those 20,126 contracts stood for delivery, 100%. This is massively sophisticated and big, big, big money. Who's got 15 billion? And even crazier, when I told you of all the silver that was delivered and then actually left the exchange, not just stayed in the COMEX, but left, who's got space to control semi-trucks, several of them, worth of silver? Anyone who's ever held a silver mint box of Krugerrands, of Britannias, Philharmonics, American Eagles, they weigh 40 plus pounds for 500 ounces. Well, who's going to take, 1.7 million ounces in 3 days of silver? Where's it going? Who's going to take it? Who's got the space for it? So you're seeing the most sophisticated, well-funded, and well-informed traders in the world, the central banks, the commercial banks, and whoever the hell is standing for delivery, who are doing something incredibly sophisticated by draining the exchanges. At the same time, the public has virtually zero exposure to physical metals. They're all in on equities as the big money's going all out, and the big money's going all in on commodities as the public is all out. We have the lowest premiums on retail level stuff I've ever seen. It is the best time I've ever seen in my career. Contrarian indicator says that will change very quickly, because when something triggers the collective awareness of the public and everyone rushes to grab precious metals, it's going to be an interesting situation, to say the least.
Yeah, I believe that the US has much better premiums. I'm from Europe. We have higher premiums than the US, so definitely agreed on that. Andy, how can people reach out to you?
The best way is if they have questions on pricing here in the US, send us, or any questions they've heard here, send us an email at info@milesfranklin.com. The price list we keep close to the vest will be as good or better than anywhere in North America. We don't publish those numbers. We allow for very small purchasing here in the States. We have our own YouTube channel, Miles Franklin Media, where we're thrilled to announce that we just brought on recently Michelle McCory. to run our channel. And of course, milesfranklin.com. I'm all over the internet. I do 4 to 5 episodes like this with others just like you every day, including my own show, Little by Little, and Michelle has hers. So they'll find us if they look. Won't take much effort, but it's always nice to catch up with you. I appreciate the opportunity and love to do it again.
Thank you very much, Andy. I really enjoyed this show, and I always learn something from you, something new. So thank you very much.
You got it, brother. All the best.